Live from New York City this morning. Good morning, good morning. A beautiful morning in New York, and trying to figure out what that inflation report means for this market. Equity futures slightly negative. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, the CPI report falling in line with expectations, keeping the pressure on the Fed to keep on hiking as the White House zeroes in on Vice Chair Lael Brainerd. We begin with the big issue, inflation in America.
A big CPI report
on Valentine's Day.
It was largely as expected.
Chair Powell essentially telling us they're data dependent.
He basically said, all right, you guys want to play data dependent? We'll play data dependent.
We'll let the data determine how the markets react.
That CPI print is kind of a sneaky risk event.
How long the CPI can really persist.
Investors have largely assumed away inflation risk.
How sticky will inflation be around this very critical 4% level?
It could be the case that US CPI comes in hot.
It's the kind of thing that could A, disrupt the rally, and B, I think embolden people to kind of lean against the rally we've seen.
I would say it could have been worse.
Mike McKee, it could have been worse, apparently.
Yeah, I like the way Steve summed that up. It could have been worse. A lot of that because much of the movement we saw in January had already been priced into the markets, even though they're trying to figure out where to go from here. The headline number up 0.5, which was as forecast. Now, that's a change from a 1/10 gain in the month of December. And the core up 0.4, a change from the month of December as originally reported, which was 0.3 gain. So we do see some hot CPI numbers. A lot of that in the headline is energy prices, both natural gas and gasoline, going up significantly. Also, we saw apparel go up, a bit of a surprise given it was January. Usually you get sales, so that may be a seasonal adjustment factor. On a year-over-year basis, as you can see, we ticked down in both categories of headline and core. Good news in the sense that it continues the progress that's being made. Now, what the Fed has been wanting to see and what we've been talking about for a couple of weeks here is Jay Powell's so-called super core. When you take out housing from the core rate, what do you get? You get a lower number. And at this point, it looks like some progress still being made. If you want to take some good news out of this, that's the one to do. The yellow line there, it's up 0.2, well, basically 0.3 for the month of January after a 0.4 gain in the month of March. It shows you that housing still has a major impact. You can see with the white and blue lines that goods prices are still going down, services prices are still going up, but a lot of that is housing. And so when housing starts to go down, we could see inflation start to fall fairly significantly. What's happening in the markets and how is that affecting the overall mood of the Federal Reserve? We'll find out more at 9:30 with Tom Barkin. But here's what the trading for the Fed funds in terms of the March meeting and then into July for the peak funds rate. It's gone up right now. We'll see if it comes back down. It looks like it's going up and down. So it's kind of hard to tell, but basically people try to figure out where we are at this point. And my guess is we're going to end up where we were before all of this, John, because, as I said, the idea that it was going to come in a little hotter was priced in.
Yeah, this market was all over the place, and now it's basically unchanged on the S&P, down about 0.1%. Mike McKee, thank you, sir. Looking forward to catching up with you again in about 27 minutes' time. We'll be speaking to the Richmond Fed President, Tom Barkin. Do not miss that conversation. The first Fed speaker to react to this number coming up in about 25, 27 minutes. I'm pleased to say that we get the first reaction now from Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, wonderful to have you with us on the programme, sir, as always. Your reaction to that print from 33 minutes ago?
So, John, my reaction depends on what I'm comparing it to. It's in line with consensus forecast. That's good news. It is not as bad as what some people were starting to worry about in the last 2 days based on very partial indicators, used cars being the example. And it is still too high compared to where we thought we would be a year ago. I mean, inflation is still too high, and on a monthly basis, it has gone up. I say this, John, because it's really important to be humble about our ability to forecast inflation over the next 12 months. There are a number of scenarios. None of them dominate in an absolute sense. And it's really important to keep an open mind as to the price formation process. And we can talk about the details of this, but just we have to keep an open mind. Let's not jump to one particular scenario because there simply isn't enough evidence to support one particular scenario.
Mohammed, let's talk about that now. You wrote about it in the last week in Project Syndicate. You talked about the disinflationary process beginning, referring to what Chairman Powell had told us a couple of times. You said this thesis may be comforting. It could also encourage dangerous complacency. How high is the risk of that now?
Very high. And the marketplace embraced it. And we saw the 2-year go down almost to 4%, 4.02. We're back at 4.50. We embraced it. We love comforting news. We love, when someone said inflation, we said transitory. When someone says possibility of recession, we respond short and shallow. And then when someone said disinflation, okay, we repeated many, many times, and we assume that it's just going to happen, what some people have called immaculate disinflation. So we have a tendency, John, to immediately go for the comforting narrative. And that, as we have seen with transitory inflation, means that we fall behind. What I'm saying here, just let's keep an open mind. I think the most likely scenario, and I give it 50%, is that we end up with sticky inflation, 3 to 4%. There is a possibility of an orderly disinflation. I give that 25%. And there is an equal probability of 25% of a U inflation, that we find out that service inflation is very difficult to bring down, including the so-called super core. And goods disinflation stops as we're seeing it happen now and starts going up. So when you're looking at 3 scenarios with very different market implications, and you can't give a deterministic probability to any of them, it's really important to keep an open mind.
That makes it incredibly complex to be a policymaker who has to confront the probabilities of each of those 3 scenarios and set policy. Mohammed, they've been talking about being sufficiently restrictive now for the last couple of months. Are we there yet in your mind? Do you think we are sufficiently restrictive?
Not for inflation and not for a 2% target. Look, John, ironically, it's less hard for policymakers than it is for market participants. It's really hard for market participants. For policymakers, you've got to think in terms of what mistake can I afford to make? And the mistake you can afford to make right now, given the underlying strength of the labor market and given how our economy in general is doing, is of paying too much attention to persistent inflation. So it's better to get the inflation genie back into the bottle than to relax too early. And you've heard me say this before, and I certainly wouldn't say the word disinflation 11 times in a press conference, because that's all that the market will hear. And in fact, it was all that the market heard.
And the market ripped and rallied off the back of it. Now, Mohammed, I wonder, as we get this incoming information, with CPI to one side, what we're learning from retail sales tomorrow, what we might find out, what we've seen from payrolls already, is it too early to say this when people start to conclude that maybe the economy is less interest rate sensitive than they thought it was? Can you draw that conclusion?
So it depends on which part of the economy, John. The reason why economists really worry when inflation is allowed to get embedded into the system is because it will migrate to sectors that are much more difficult to get to via monetary policy. Services is an example of that. So if it's housing inflation, you can get to it through monetary policy. If it's goods inflation, you can still get to it. When you get to service inflation, in order to get to it, you end up creating quite a bit of collateral damage in the process. That's where the worry is that we've allowed inflation to migrate to the service sector, and with that, it becomes harder to control. And that's, I fear, that is what we're going to see when inflation gets sticky.
So Mike Gapin of Bank of America has said there's evidence that this US economy is difficult to slow down. I mentioned Andrew Hollenhorst, the Citi recently, who said the data's pointing to a longer expansion. Vishy Tirupati of Morgan Stanley saying the same thing. The hard data's too hard to ignore. In your mind, Mohammed, since this year has started, are you pushing out the length of this cycle at the same time you think the risk might be increasing, inflation is sticky? Are those two happening hand in hand?
John, I remember being on your show when Bloomberg came up with this very dramatic headline, which you've maintained for a while, 100% probability of recession. And I said, no way, it's not 100%. It's not even close to 100%. Yes, there's a possibility, but it's not 100% probability. We can avert a recession. And the last few weeks of data suggest that we can still avert a recession. Now, that's a good thing. I want to stress that is a good thing. That's not a bad thing. That is a good thing. If you look at the internals of the data, just look at food inflation in today's print. It's very easy to see that it is the most vulnerable segments of our population that are suffering. So the last thing we want to give them is income insecurity on top of eroding their purchasing power on essentials. So I'm hoping that the strength of the economy stays, because the alternative, John, of a deep recession to get to a 2% target that is itself arbitrary, I'm not sure that that is the right response.
Are you saying the 2% target should be pushed aside, de-emphasized?
So it is very difficult to change a target when you have missed it for so long, because the minute you do that, your credibility is hit even harder. I think that if people sat down today, they would not come up with 2%. They would come up somewhere between 3 to 4% for two reasons. One is that the supply side is changing, and you need relative and absolute price changes to lubricate that change. And the second is we found out 2% is not far away from the zero bound. We thought it was, but it's not. So we'd go to 3 to 4%. I think the most likely outcome, John, and you and I have discussed this, is that inflation gets stuck at about 3 to 4%. The Fed keeps on promising us 2% in the future. And hopefully we learn to live with stable 3 to 4% inflation, and then we can make something de facto de jure.
You've been very critical of this Federal Reserve, rightly so, over the last couple of years. No doubt about that. You said they need to be open-minded, more open-minded about what's happening. Now, we had one viewer write in a question on the Bloomberg terminal who said, do you think the fact that the Fed has said they are data dependent, does that mean that the Fed does have an open mind? Is that evidence of that?
No. Data dependency means I'm short-term, okay? If you think of what the Fed is trying to do, it is trying to combine data dependency, short-term, with the reality of long and variable lags for their tools, longer-term, with the correct observation that Chair Powell made last week, that some issues are more structural than cyclical, right? So it's data dependency by itself is not keeping an open mind. You've got to also be open to different scenarios and sit down and figure out what are recoverable mistakes, what are non-recoverable mistakes. When we look at multiple scenarios, the likelihood of making a mistake goes up. It's not that you want to make a mistake. It's just that the world has become, as Larry Summers said on your network, it's a very difficult economy to read.
He often says that to David Weston. It's an incredibly difficult economy to read. So let's finish on the policy suggestions. Mohammed, I think the one key risk for a lot of people in this market over the last 18 months has been the risk of a bigger terminal rate, a higher terminal rate, the upside risk around that issue. Do you think that's still pronounced? And if you had to take a best guess now, and this is slightly unfair of me to ask, but if you had a best guess for the terminal rate, what would it be?
It'll probably be higher than it is now, than what the market has priced in, I think at 5.15 last I saw. And then we would stay there for a while. We wouldn't come down as the market thinks. The market thinks that by the end of the year, we'll be down about 25 basis points from that peak rate. I don't like calling it terminal rate. I like calling the peak rate for the cycle.
Drop the jargon, essentially. Mohammed, thank you. As always, just wonderful. Mohammed Al-Arian of Bloomberg Opinion in Queen's College, a good friend of this programme, and a brilliant mind on the economy and on the Federal Reserve. We're going to catch up with Tom Barkin of the Federal Reserve and the Richmond Fed in just a moment, about 20 minutes away. Don't miss that conversation. Equity futures right now down 0.25%. Yields higher by 5 basis points, 4.56, pushing 4.57 on a 2-year. Coming up, inflation in America picking up.
As long as shelter costs are going up as rapidly as they have been, it's going to be tough to get inflation down anywhere close to where the Fed would like to see it.
More on the CPI report with Nuveen Sarah Malik, Krishna Mamani of Lafayette College, plus that Fed exclusive coming up shortly.
It was largely as expected, but I would say it could have been worse. Some of these volatile categories that had been driving down the readings in late 2022 continued in January, and we still got a 0.4 as long as shelter costs are going up as rapidly as they have been, it's going to be tough to get inflation down anywhere close to where the Fed would like to see it.
A hot inflation print coming on the heels of a blowout jobs number, reinforcing the Fed's message of higher for longer. The report also, of course, keeping the pressure on the White House. A bit of news on that. President Biden zeroing in on Fed Vice Chair Lael Brainerd to lead his economic team. We make an announcement on that as soon as today, according to our reporting down in Washington, D.C. Before we get to that, equity futures right now down about 1/3 of 1% on the S&P. Yields a bit higher by 5 basis points, close to 457 on a 2-year. Here with us to talk about that CPI report, Nuveen Sarah-Malik, Krishna Mamani of Lafayette College. Let's go first to you, Sarah. You were looking for a hot print. Your response to what we got?
Well, there's something for the bulls and the bears in this number. The number's not as bad as feared, but if you look under the hood, very sticky shelter prices up 0.7, and also used car prices down, but we've seen the real-time data where used cars prices are increasing, so that's yet to come into this number. Key question is, what does it mean for monetary policy? I think it brings back the likelihood of a third interest rate hike. My concern is around market valuations, which are up a few ticks year to date, and also these high beta stocks that have rallied quite strongly. I think that's where you're at biggest risk of an unwind in the markets, given inflation is sticking around for the time being.
Krishna, coming into this, you said even if it was hot, it won't alter the policy path meaningfully. Is that still the case?
Oh, absolutely. First, it wasn't hot, so that was a bad assumption on my part. But the policy path, the Fed has actually articulated that quite well, which is what they're focused on really is the labor market. And I think the January labor market report was far more important than the CPI report. If we see a few more of those, then we'll have a potential problem on our hands. But hopefully that gets washed away. But the core thing that the Fed is focused on is really the labor market, the tightness, and the wage growth. And that matters a whole hell of a lot more than anything else.
Well, we've got to talk about the equity market as well. Futures down this morning by 1/3 of 1%. Marko Kolanovic of JP Morgan had a tough time last year calling this market. He was bullish as it was selling off. He turned bearish as it rallied. He says this on this equity market right now. We see the equity risk reward is skewed to the downside. Do you see it the same way, Sarah?
I think probably after the year-to-date rally we've seen, it likely is skewed to the downside because we're pricing in a soft landing. My concern for this year is earnings, already in fourth quarter earnings. Margins are seeing declines. We were expecting to see that. I think the next shoe to drop is pricing and revenues. Revenues are expected to grow this year. And also 2024 earnings, or consensus is up 12%. Those are going to be hard numbers to meet if the impact of monetary policy finally comes through and we do see some form of an economic slowdown. So I think that's going to be the issue, and that's why valuations will have a hard time staying where they are because they're at a premium.
This rally has been so painful. It is the ultimate pain trade. The S&P year today up 8%, the Nasdaq something like 14% higher. Krishna, you said it a few times on this program already this year. You said this is the pain trade. 4,500 maybe on the S&P. Is that still the case?
Oh, absolutely. I think given where nominal growth is, the likelihood that the equity market goes down on its own is pretty small in my judgment. So I think that's what we are dealing. The onus is really on the bond market to take the equity market down. And off late, they have started playing a bit of ball. But I think relative to the message of the Fed, which is they're going to get to terminal rate at some point and stay there for a long period of time, the bond market doesn't believe that. And I think until it starts believing that, the upward path in stocks probably persists for a little bit longer than what most people think.
Krishna, is there a disconnect between what's evolving right now with a 2-year yield up 5 basis points to 457? Only a couple of Fridays ago, the morning of payrolls, we were threatening to break 4% on a 2-year. We're higher by more than 40 basis points since then. Wasn't even 2 weeks ago. Krishna, I'm seeing that take place, and yet the equity market seems pretty resilient. What is the connection between what's taking place in bonds and what isn't taking place in equities?
I think what hasn't changed, and the reason why equity markets haven't come down, is we are still expecting rates to be lower by the end of the year. I think that particular issue has to be resolved by data, because that is really the disconnect between what the Fed is telling us and what the bond market believes, and which is getting priced into the equity market. I think we have taken some of it off, but we still are far more sanguine than what the Fed would like us to be.
Disconnect is a word that keeps coming up on this program, Sarah. Morgan Stanley have talked a lot about a disconnect in this market between what they think is disappointing earnings and what other people would agree on and what's taking place in equities. Sarah, what do you make of all of this? Is there a disconnect?
I think there is a disconnect. Look at the yield curve. It's been flashing a recession warning. But the question is, when is that going to happen? And with the strong employment numbers, the strong consumer numbers that we're seeing, it likely pushes off the timing of a recession. And that's what the markets are trying to understand. So, we're watching that closely, but I think the recession question could be later this year. It could be in 2024. Until then, you could see the market continue to be in this trading range, continue to muddle through as it tries to determine when should we price in the recession. Odds of rate cuts for us are off the table for end of this year. I don't think you're going to see that until you hit that recession. And this strong economic data, particularly in the employment market, tells us we're not near one anytime soon. But we have not seen the impact of what the Fed has done in terms of tightening yet hit the economy. Therefore, I don't think we can rule out the idea of a recession from the table.
Staples did their job last year. Let's talk about the bucket of this equity market you want to be in, Sarah. Staples did their job last year. PepsiCo put out some decent results. Coke this morning. I know you like the latter. Can you tell me why?
Yeah, we do like Coke over Pepsi. We love their geographical diversification. The fact that they're focusing on growing revenues completely rather than just on volumes. They've been a bit of a laggard versus Pepsi. So we thought all that was a nice setup for Coke going forward. Overall, all Staples, though, we like dividend growers even better, which is not just Staples. These are companies with strong balance sheets, ability to continue to grow their dividends. They look cheaper than just some of these bond proxy areas such as Staples. So I'd say selective in Staples, Coke over Pepsi. But then look at these companies that can grow their dividends, low volatility, provide income to shareholders while we own the companies.
Cautious approach to what you think might be a difficult year. Sarah Malik there of Nuveen, alongside Chris Mamani of Lafayette, who's taken completely the other side of this, at least in the short term, who thinks that pain trade's 4,500 on the S&P. Thank you to you both. Equity futures down 1/3%. Coming up, the morning calls, and later, an exclusive conversation with the Richmond Fed President, Tom Barkin, and Mike McKee just around the corner. Looking forward to joining that one. We'll do that in about 7 minutes' time. Around about 5 minutes away from the opening. Equity futures right now down 1/3%. Let's get you some price action. The Nasdaq down 0.4%, and here are your morning calls. Evercore downgrading First Solar to inline, saying benefits from the Inflation Reduction Act are now largely priced into shares. Goldman upgrading Occidental to buy, highlighting the stock's recent underperformance and improving cash flow. That stock up by 0.5%. And finally, Argus downgrading Lyft to hold, seeing limited upside with intense competition weighing on margins. We're negative there about 2.2% at $10.23. Coming up on this program, an exclusive conversation with Richmond Fed President Tom Barkin. That conversation about 4 minutes away, around the opening bell, with futures lower by 1/3%. And yields higher in the bond market by 6 basis points on the 2-year, very close to 4.58. Your opening bell up next. 24 seconds away from the opening bell this morning. Good morning to you. Equity futures shaping up as follows on the S&P and on the Nasdaq. Yesterday, a decent day of gains on the S&P 500, taking back the week of losses from last week, which incidentally was the biggest week of losses of the year so far. Equity futures negative 0.4 on the S&P. On the Nasdaq 100 down 0.5%. On a Russell, the small caps down 0.7%. That right there is your opening bell. Joining us now on Bloomberg TV and on Bloomberg Radio, I'm pleased to say that we're joined by the Richmond Fed President Tom Barkin, alongside the brilliant Bloomberg's Mike McKee. You happy with that introduction, Mike?
I like that.
That worked for you? Good.
Yeah.
And the brilliant President Barkin.
Mail.
Tom, great to catch up. Thanks for being with us.
Yeah, thanks for having me here.
So we get some Fed speak 60 minutes after the inflation report. So let's start there. Your response to that CPI print we got a little bit earlier.
It's about as expected. Inflation is normalizing, but it's coming down slowly. And I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. Part of that is still COVID factors, excess money in people's pockets, supply chain issues in places like cabinets and switchgears. Part of it is business factors. There are businesses out there still trying to recover lost margin. But I think the biggest thing is that after the experience of the last couple of years, businesses have now understood that pricing is a lever again. And as I talk to the folks in my district, I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are.
So one thing we've heard from Fed officials, including the chairman, is that the disinflationary process has started. Is that something you agree with? Do you see much evidence of that? And where do you find that evidence?
Well, if you look at the 12-month numbers, you can see they peaked several months ago and they're coming down steadily. But that's one part of the puzzle is inflation coming down. The other part is actually hitting our target. And so it's going to take a while to get to there.
Do the latest data that have come in, not just today's CPI, but the jobs report, et cetera, change your view of how far the Fed will have to go beyond perhaps what was in the SEP for December? And does it change your view of inflation dynamics?
Well, I try not to get too wound up in any particular data read, particularly a January data read, large seasonality factors, all that sort of stuff. But I do think what we're now in a position to do is to react to multiple months of data as they come in. We may or may not choose to take rates up further if inflation continues to persist, but we'll have to see what happens.
Well, based on what you're seeing right now in terms of the path of inflation, the dot plot said 5.13% in December. You think that's enough?
I think we'll see. We're going to get a PC at the end of the month, another CPI before the next meeting. And then I think as the meetings go on this year, we'll see what happens to inflation. If inflation settles, maybe we don't go quite as far. But if inflation persists at levels well above our target, maybe we'll have to do more.
Well, do you think that maybe you and the markets are on a different time frame? You're going meeting to meeting, and they're looking out towards the end of 2023, saying you should be cutting rates by then?
I'm not sure I understand markets. You guys are much better than I am. I'm very focused on what's happening in the demand in the economy. I'm very focused on what's happening to inflation. And I think the way to think about my view on rates is were inflation to persist, we might have to do more. If inflation doesn't persist, maybe not.
How do financial conditions factor into that call, into that view? How do you think about financial conditions?
Well, there's lots of definitions of financial conditions.
How would you define it?
I think that as we raise rates, the market and all markets, sort of respond to how we're doing things in the path that we forecast. There are people who are out there saying financial conditions are back where they were a year ago, and I say, I don't know. It looks like rates are higher than they are a year ago. Certainly, if you're trying to get a mortgage, that's what you'd think. And so the financial markets make their forecasts, and lending conditions, whatever, work off of that. I think you can try to manage it, but I'm in the world of try to define your response function, try to live to your response function, and I think markets will catch up to what you're doing.
If we can dig a little bit deeper, we've had a decent equity market rally year today. Credit spreads are, I think, something like 200 basis points tighter than the wides of last year. Do you see that as complicating your ability to tighten financial conditions and bring inflation back towards target? Is it something that's on your mind a lot?
I think trying to manage markets, at least for me, is a fool's errand. And so I'm in the world of trying to manage what we can control. If demand stays hot, if inflation comes in elevated, have rates move more. There are lots of other scenarios of what happens to the economy, and we'll respond to those.
Well, one of the questions that people are asking is, does it make it harder? Is the market pushing back against you, and do you see inflation maybe stickier because of that? And is it a question of you have to raise rates higher or leave them in place longer and wait for the cumulative weight of tightening to hit?
Well, I think there's a very good case for leaving rates higher for a longer period of time to allow that tightening to hit. I do think the lesson of the 70s was very clear, which is don't give up too early. And anything I've read, and I've talked to lots of other people who seem to have understood that market, they say, if you go back to the Arthur Burns years, it was raise rates, economy weakens, lower rates, inflation comes back stronger, raise rates, economy weakens more, lower rates. That doesn't seem like a path that makes a lot of sense to me.
Does history weigh on you when you refer back to the 70s? Do you really feel the weight of that?
I've done a lot of reading about it, and I think for better or for worse, we've got a really good episode where our predecessors did the right thing and got inflation back under control. And I think that's certainly an aspiration for me and for us.
You understand the view of market participants that when they hear things like the disinflationary process has started, they get the sense that we're moving away from that language, that we want to learn from the lessons of the 1970s, we want to be tighter for longer. They see that as new information. The first step, and you'll hate this word, the first step towards a so-called pivot. Why isn't it that?
Why isn't this a pivot?
The first step towards one. By acknowledging the disinflationary process has started, for some people, market participants that speak to us on a daily basis, they view that shift in language as a step away from the Chairman Powell address we got in Jackson Hole, Wyoming, which was 8 minutes, down the camera, super blunt, there's going to be pain, it's going to be painful, but if we don't do this, it's going to be even more painful. 4 or 5 months later, with an equity market rally in between and a bit of deceleration, in inflation data. It's now the disinflationary process has started, and that's the focal point for so many people. Why isn't that the first step towards a pivot that says, okay, we can back away?
Shoot, I just try to keep it simple for myself, which is nobody really knows how inflation is going to play out over the next year, over the next 2 years. And so I think what I can do is talk about how I think about it. The way I think about it is if inflation stays elevated, if it persists, we'll have to do more.
Well, you struggle with what the markets are thinking, but you're probably very good on what companies are thinking because, of course, that's your background and you talk to CEOs all the time. What are companies thinking? You mentioned that some are still pushing the envelope on prices, but what's their outlook for growth and particularly employment and wages over the next 6 to 9 months?
So the way I put it is everybody's got a recession playbook. It's in the drawer. They've taken it out, they've dusted it off, they've updated it. Right, they have a very clear sense of if things were to turn south, what they do. For the most part, they haven't turned the pages of the playbook, and the reason they haven't turned the pages is that their business actually remains pretty sound. Now, that's not true if you're in mortgage lending, that's not true, obviously, recently in the tech world, but in most of the businesses I talk to, it's still not the point where they pull that. And part of it is they've really fought hard for 18 months to get workers, and they're really reluctant to shed workers if it turns out that they didn't need to. And so I think there's still a reluctance. And when you see things like the recent jobs report or some of the consumer spending data we've seen for January, you start to see that in the business's actual demand set. And they're saying we're not there yet. But of course, we all know it. The world could turn and they could get there. I just don't think they're there yet.
Well, that brings up an important question about your reaction function when you're predicting that unemployment is going to rise significantly because you're trying to clamp down on demand, and it doesn't happen. How do you incorporate that into your thinking about where you are?
Well, I think we've taken rates to where we've taken them. We've signaled, or at least I've signaled, that if inflation persists, I'll continue to respond appropriately. You do know that there are long and variable lags with rates. And so you're watching the demand side, not because the objective is to manage demand, but because the objective is to manage inflation. And so you're looking for signals that inflation comes down. You're looking for signals that demand is weakening, softening in places where that would be relevant to inflation coming down, and you play it out.
Can you explain longer variable lags to us? Because some people have come on in the last 12 months and they've said to Mike, they've said to myself, to Lisa, to Tom on Bloomberg TV and radio and said, they're not that long at all, they're pretty short. Financial conditions will price it all in immediately, they'll tighten, and you'll feel it pretty quickly. Are they that long? Are they that variable?
You didn't like financial conditions a second ago, and so we'll work on that. I do think we've seen in a number of sectors, particularly interest-sensitive sectors, particularly sectors where the strength of the dollar matters, you've seen demand move very, very quickly. And well before we started increasing rates, mortgage rates increased, and that, of course, meant the lag in that sector was less than the world where we used to hide what we're doing.
Yep.
On the other hand, if you go in lots of other places, think healthcare for a second, a big part of the economy, it's not at all clear that the rate stuff we've done or are doing is having that much impact on demand there. I think that's where it takes more time. And the studies I've seen suggest that there's a period of time to go from raising rates to the impact on demand. But I think the real issue here is from impact on demand to impact on inflation. And that's really, when you talk about the long and variables to inflation, and then I get back to where I started. And I would just say, there's the sales department, the finance department. The finance department loves raising prices because it's the fastest way to move the bottom line. The sales department historically has been very nervous about doing it, either because of incentives or market share or whatever. After the experience of the last couple of years, the finance department has a lot more sway in that conversation than they used to.
So how would you characterize the balance of risks at the moment? With all of that in mind, and it's tremendously difficult to confront as a policymaker, Chairman Powell said repeatedly a few times last year that the risk of doing too little outweighed the risk of doing too much. Is that still the case?
It is for me. I mean, we're still in a 3.4% unemployment economy with inflation, depending on which measure you want to look at, well over our target, 6% on a 12-month basis. Feels to me like the risk is on the inflation side at this point rather than the economy side.
We are talking with Richmond Fed President Tom Barkin on Bloomberg Television and Radio. Thank you to all of our viewers and listeners around the world. What is your view in terms of the growth outlook at this point? It seems like we went through a phase of recession's inevitable, then, we're going to have a soft landing. You have people saying no landing. Where do you come down on all of that?
You know, I keep trying to look at past recessions or past economic tightening cycles and ask the question of which this is most like. And of course, the ones that are most recent in our memory are all recessions where something winged in from left field, whether that be 9/11 or the financial crisis or the pandemic. And so I think we may be looking at an economy more like the one that I remember back in the early 90s, where there was a tightening cycle. And different sectors got hit one at a time. It seemed like much more of a rolling situation. And so the overall numbers perhaps aren't going to be as negative. You know, again, I'm assuming nothing comes in from left field, but aren't going to be as bad as the ones we remember them from 2 years ago or 15 years ago. But we'll see.
Well, when you sit down on March 22nd with your new projections for the economy, are you marking up growth? Are you marking down growth? What do you think is going to happen?
I've got a month before I need to make those projections. And I'm teasing, but I'm quite serious about it. We have a real serious process. We run multiple models on this. We take in all the most recent data. We will get another jobs report, one perhaps with less seasonality impact. We'll get another PCE and a CPI. And so I wouldn't want to front run our team and our models on that forecast.
Just in terms of risks around the view already projected from December, upside risk for growth, for inflation, for the terminal rate, how are you thinking about things currently?
Well, the biggest surprise has been the jobs market. I mean, the jobs report we got a couple weeks ago was quite significant and much stronger than what I had anticipated. And so the question in my mind is going to be, are we going to get another one like that in February, or are we going to get something in February that revises, corrects, moves it down? So I think that's really the key thing I'm looking at in terms of growth.
It's been surprising for all of us to see unemployment come lower. There was a take, I think, last year. Mike, you and I used to talk about it all the time. This is the Fed's job. They need to get unemployment up to get inflation down. And it sounded ugly, it was brutal, it was difficult to communicate as a policymaker. Do you still see it that way? Do you need to get unemployment up to get inflation down?
I see we need to get inflation down to get inflation down. And what I mean by that is, our tools work on demand, they work on lots of various things, but the key to this whole thing is getting inflation down. I don't start with unemployment, I start with inflation. And we'll see what happens on the employment market. We're still at 3.4% unemployment. That's a historically low number. You're talking 1969, and before that, 1951. And so, there's been a lot of talk about the jobs market so far, quite strong. We'll see what happens.
Are people in the companies in the Richmond district telling you that they are still having trouble finding people, or has that eased?
It's not as desperate as it was a year ago or a year and a third ago, but it's still very tight. On the professionals, though, I think that has kind of loosened. Some of the layoff announcements recently have sort of hit home. People trying to hire tech workers are having an easier time doing it. For the frontline service workers, still very tight. But people are getting by, whether it's lower service levels or not cleaning the hotel room every day. The place that's still screaming tight is skilled trades. Construction, nurses, truck drivers. We just don't have as many as we need. Demand in a lot of those places remains elevated. And folks are really struggling to find those folks. That's really where it's the tightest.
Let me ask you about the balance sheet. It's been running in the background. It's been paint drying, but there have been concerns expressed in the short-term money markets, and we're still seeing a lot of money put back into the repo facility. Is it working the way you want it to? Are you getting the results that you want, or is this also a case where the markets are not reflecting necessarily what you're trying to accomplish with QT?
I think we did a bunch of actions we thought important at the time in terms of stimulus and supporting the markets back in 2020. We're now trying to unwind that. I think our primary tool is the rate tool. It's not the balance sheet tool. The objective is to unwind the balance sheet expansion that we did and do it in a way that doesn't change any focus on our primary tool, which is the rate tool. You guys still seem to be focused on the rate tool, so I think so far so good.
We're focused on the balance sheet too, so let's stay there. I'm sure you're pleased that people see it as paint drying, but it's not. It wasn't just an objective to get the balance sheet up. You were looking for a consequence from doing that. You said the objective was to get the balance sheet down. Are you not expecting there to be a consequence there?
I mean, first of all, the analysis of the impact of balance sheet movements is unbelievably difficult, arcane, opaque, and tortured. And so I've really struggled as I've kind of come into this to come to ground to it. Where I've landed is it's got to be symmetric. If you believe that adding to the balance sheet does something, then you got to believe that shrinking the balance sheet does something else. So I've got no question about that. I do believe that on both the expansion side and the reduction side, it's a lot smaller than some of the estimates you'll see. And people talk about the impact of buying more bonds. There's also a signaling effect when you're buying. I think the signaling effect may actually outweigh the impact of buying the bonds. The signaling effect in terms of when you would finally raise rates or whatever. When you're shrinking the balance sheet, there's a shrinkage effect, and then there's a signaling effect. The shrinking effect, of course, I would say is parallel to the expansion. And then the question is, what is the signaling? The signaling tends to be around liquidity. That's the conversation that gets raised. I just would come back and say, compare today's balance sheet to 2018 or 2019's balance sheet. It's still so much larger that I have trouble seeing that liquidity is actually being driven by what we're doing right now.
Back at home, what worries the people of the Richmond district? I mean, we have the idea of a possibility of recession. We've got what's going on with energy prices because we don't know what's happening in Ukraine. There's this whole idea of the debt limit leading to a default. How much are people in your area focused on those things?
What I hear over and over and over again is that people hate inflation. And that's what they're focused on. I mean, people hate inflation because it seems unfair. I mean, you get a raise and then you spend the money you just got at the gas pump. It feels arbitrarily taken away, creates uncertainty, and it's just exhausting. It's exhausting to shop around for better prices. It's exhausting to defend your prices to a customer. And so people are really excited about the prospect that we might get inflation under control, but you don't have to look much beyond the sentiment indices to see what people think about inflation, and that still is the overwhelming conversation we're having.
I have to ask you this. It appears that at the Federal Reserve, you're going to be in the market for a new vice chairman. Lael Brainerd, what does she bring to the Fed and to the Open Market Committee? How would you characterize her tenure?
Well, I don't know what will or won't happen from the administration, but Lael's an asset. I mean, she's very smart, she's very capable, and she's an asset to us, and if she does something else, I'm sure she'll be an asset there.
She's been seen as one of the doves on the board. Is there such a thing, and was she?
We have 19 really, really capable people on the committee, and I listen to every one of them because every one of them brings a unique view. And as we've learned in the last few years, people's views change as the data comes in. And so, I've got colleagues that you might think are doves who might go the other. I mean, I think so. Yeah. I think people take the job very seriously, and they're very genuinely interested in landing the plane on whatever is actually the situation in the moment, as opposed to, I'll call it, a pre-existing leaning.
There's rarely any dissent. Why is that?
You mean dissents or dissent singular? Because I have the privilege of sitting in the meeting, and there's lots of points of view that are phrased. So I wouldn't be confused about the idea that there aren't a lot of different points of view raised.
Give us a bit more clarity on that, because from the outside looking in, sometimes it feels like groupthink. There aren't people that come out that say, I disagree with the decision and this is why. It's incredibly rare, particularly from the board. How much of that is actually taking place inside the building around these decisions that we're just not aware of? Why isn't this groupthink?
Well, I spend my time every 6 weeks, 7 weeks per meetings. I go into the market. I don't spend a lot of time in my building. I'm trying to figure out as best I can what's happening in the economy from people who are participating in it. I try to come up with my own points of view in terms of what's happening to economic conditions and where we ought to go with policy. And I show up with my points of view. And then every time I go there, I learn something. And I learn from people who are doing the exact same thing with their own independent views. I think the structure of the system is very well set up to gather independent views. And then, of course, the meetings are very well led in an effort to put those on the table and try to land on a place where you can get some version of a consensus.
One of the things people have been critical of is that there are 19 members of the Open Market Committee who are speaking all the time, and it can be confusing to markets and to the public. Do you see that as a valid critique?
Well, I'm privileged to be here, so I guess if I say no, then I'm asking why I'm here.
You're the only one that's allowed to come back regularly every day.
No more interviews after that.
Exactly. I see a huge part of my job as trying to translate what we do into the district that I serve. And so, like I said, I really am on the ground all the time. I'm doing chambers of commerces in small cities. And I think there's a real thirst for understanding. And I think there's real value to the people in our community hearing from and understanding people who they think are actually rational, not, people from Washington, if I could put it that way. And so I think there's huge value in that. You guys choose to cover it. I'll leave it to you whether that's the right thing to do or not. But I don't see it as getting out. I mean, I see it as actually talking to the constituents in my district.
Just one final question, and you've been incredibly gracious with your time, so thank you for that, Tom. It's the third year of pandemic economics. China's reopening. I feel like the consensus has been dead wrong every single year on every major issue. As we go into the third year of all of this, how are you thinking about that challenge as a policymaker? Is there something you're hesitant on drawing too many conclusions on too prematurely?
Right. I think we're normalizing, but you can't ignore the impact of the pandemic, that the pandemic is still having in the economy. Some of the things we've talked about, businesses reluctant to shed workers because of the history, shortages in switchgears and cabinets, $1 trillion plus in excess savings still out there, the infrastructure bill still being deployed. All of these things are, if I could call it, not normal, artificial things that are in the economy today that weren't in the economy 3 years ago. Now, for me or for us, you have to take it as a given. And so you try to make policy against the economy you've got, not the economy you wish you had. But I think for sure you've still got that in the economy.
President Barkin, thank you. You can do as much Fed speak as you like, just so long as it's like,
right here.
With
we're
Mike McKeon,
every day.
I appreciate the time. Thanks for having me here.
Thank you. That was Thomas Barkin, the Richmond Fed president. Coming up, the market moving events you need to be watching. We'll get to the trading diary in just a moment. Live from New York, this is Bloomberg.
Trying to manage markets, at least for me, is a fool's errand. And so I'm in the world of trying to manage what we can control. If demand stays hot, if inflation comes in elevated, have rates move more. The biggest surprise has been the jobs market. I mean, the jobs report we got a couple weeks ago was quite significant and much stronger than what I had anticipated. And so the question in my mind is going to be, are we going to get another one like that in February, or are we going to get something in February that revises, corrects, moves it down? So I think that's really the key thing I'm looking at in terms of growth.
Fantastic to catch up with the Richmond Fed President, Thomas Barkin, there alongside Mike McKee as well. Just a little bit of response there to the CPI report we had about an hour and 25 minutes ago. Not much of a market response, very jumpy in the minutes afterwards. Right now, totally unchanged on the S&P 500. On the Nasdaq, positive 0.2%, trying to build on the gains of yesterday's session to start the week. That's the equity story. Here's the bond market. Yields higher, particularly at the front end, by 6 or 7 basis points. Very close to 460 at 458 on a 2-year. Yields up 6 basis points. New highs for the year there. That's the price action. Let's get you the trading diary. Coming up, Fed Speak continues. Logan, Harker, Williams all on deck. President Biden discusses the economy, 1:15 Eastern time. Retail sales tomorrow. Big data point for us to cover together. Jobless claims on Thursday. And finally, some more Fed Speak through the week. Mester, Bullard, Cook, Barkin, Bowman to close out a week. From New York, that is it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.